Hello, this is Martin from seekedge, the channel for learning about trading and investment. Welcome to the Option Trading for Beginners series. Today, we are going to discuss about bearish spreads, which consist of the bear put and the bear call spreads. Let's see what are those. The last video, we talked about bullish spreads. I hope you had watched the bullish spreads video. If you have not watched, the description of that is given and the playlist also available. Please watch the same. Some of the terms or some of the slides may be having repetitive content, but for the benefit of people who are viewing this for the bearish spread video for the first time, I'm including that. Please bear with that. So let's get into some of the terms that is used in the slides ahead. When we say spread, what is a spread? A spread is nothing but option trading strategies where we have both long and short options that is put together. Not just say long only, not just short only, right? We are using both puts and both long calls. We are shorting as well as we are going long, so that our risk is reduced. Such kind of strategies are known as spreads. Now, another term that we use is directional versus non-directional option strategies. Directional, what we are still going to learn today is bearish strategy, and what we learned previously, bullish spreads. Both are directional because we know the direction. We know in the sense we have a view on the direction. It may be correct or may not be correct. If it's correct, then we make money. Otherwise, we lose money. Right? We take a view based on different techniques, on charts or open interest or different kinds of analysis of data and charts. We get to know a view and then we take the positions accordingly. Non-directional does not have a view, but there will be a range of price movements that is expected, but not beyond that. An exact view on which side it will go, it's not known. Such option strategies are known as non-directional. Right? In this strategy that we're going to learn also, in case our view fails, we may convert as an adjustment this directional into a non-directional. We'll get to know about non-directional also in our future videos. Now we are talking about bearish view. What do you mean by bearish view? Bearish view in the sense we are expecting the price to move down in the future, in the near future, right? Now another term that we use is risk defined. What do you mean by risk defined? The risk is known. We know how much we're going to lose maximum if we end up in the wrong way, if the price moves as against what we wish it to be, right? So we know what's the maximum loss, we know what maximum profit, we know the capital that is involved, we know what is the return of investment, we know when we can come out without profit or loss, we know what is the probability of this winning and what is the probability it is losing. So all these parameters are known as risk defined. Any strategies in the options which are the nature of what we are studying, bullish, directional or non-directional or bearish, right? All these kinds of option strategies will be having the risk defined. Let's get to see what is bearish option strategies. There are different types of bearish option strategies, right? So bear spread is what we are going to learn, the first two, bear puts option spread and the bear call spreads, right? Then we have the plain naked long put spreads, that is also bearish, right? We are not going to learn about that because it's high risky, right? So we are talking about spreads, we are not talking about only long, right? We are talking about long and short. We are talking about strategies where the risk is defined. We are talking about strategies where we don't lose too much, right? So we will not be covering the long put. Put butterfly also is not the scope of this slide. Put butterfly is where we have multiple lots of put and then we hedge the positions. We are not covering that. In future videos probably we may cover it. What we are going to learn is two bearish strategies, which is bear put and bear call spreads. Let's see what are they. So the first one is bear put spread, right? So as the name indicates, it is made only of put options. That means you are bearish and you are taking the strategies with the help of put options only. You do both the buying and the selling of the put options so that you can minimize the risk. So what do? We buy in the money put option, and at the same time we sell an out of the money put options. That is how we construct a bear put spread. So this is how the payoff chart for the bear put spread looks like. As you can see here, 16,000 put option for 29th July 2021, which is having a premium of 325 rupees, right, is what is bought, And what are we selling? We are selling 15,700 put option with a premium of 178 for the same expiry. We are shorting it, we are selling that. So when you do this, it becomes a spread. So what is the probability that we can see here? We are seeing that there is around 60% of probability is that we can win, 40% we may lose. What is the maximum profit that we have? It's defined there. Loss, the risk reward ratio. What is the break even point where we will be neither profitable nor loss, more or loss, right? That is also mentioned there. It's 15,852, right? And my margin amount is also put, and this is a debit strategy. So we'll see how these values are derived. How do you find this? No, we can find this by using tools like Sensible or Obstra easily, but we can find it manually also, or with the formulas for it put into the Excel sheet also we can have this. So payoff diagrams help us to know which points, what is the risk parameters, how is the risk defined on each of these elements. That is the use of them. So before we take a position, we need to understand all these parameters before we put the order, rather than going straight away and placing the order. Let's see how these parameters are found. So for the bear put, maximum profit is the strike price differences, the strike price of the long put and the strike price of short put. What is the difference? That minus, you have to subtract net premium from that. So what do you mean then? If you look at this, 16,000 is the strike price, right, of the long, 15,700 is strike price of a short. The difference between that is 300, right? So to find the maximum profit, what do you do? 300 minus net premium. Net premium is what? Net premium, we can see that, I'm sorry, it is gone. I'm just going back. Yes, so net premium, we can see that is 325 minus 178, somewhere near to 150 it will come. That 150 we have to subtract it from the 300, which is strike difference. So it will come to somewhere near 150 something, right? So that multiplied by the lot size is 50. For 29 July it is 50 lots. It will come to the maximum. It will come to the maximum profit that is mentioned here, which is 7,648. Now how do you find the maximum loss? It is equal to the net premium. Net premium is what? 325 minus 178. This is coming to somewhere near 150. Multiplied by 50 is 7,352, which is exactly the maximum loss. Now break-even point, how do you find the strike of the long put? What is the long put? 16,000 minus what? The premium. Premium is what? Premium is, net premium is 325 minus 170, it's come to 150 something. So 15,852 is the point where it breaks even, right? If the price comes to that place, we are neither profitable nor profitable. If price moves back, we are profitable. Price moves front, right, we will lose, because it's a bearish strategy. So that is what the risk parameters. Now when do we use this bear put? We use it, as we know, when we are moderately bearish, right? If in the short term period, in the near term period, if you're taking a weekly options, in that few days we are bearish. If you're taking a monthly options, if you're taking a bear put, it means in that month we are bearish. So the price is expected to go to downside. That is what our view about the market is, right? So in order for that, we might have come to that conclusion by seeing that there is a resistance level that is there up there at this price point. 16,000 may be a resistance. That's why we are assuming that the market would be bearish. It may move a little bit and then it may turn bearish and in favor of you, right? So the implied volatility levels has to be very low, and if you're taking the stocks, it has to be volatile and liquid stocks, right? So bear puts are good if the implied volatility is less than the historical volatility, 1 year historical volatility. If that is higher, then it is better to put the bear puts and the bear calls. Let's move it. What adjustments do we make for the bear put spreads? Adjustments are made when view is going wrong, right? We expected something and we expected the market to come down, but the market went up, right? So different scenarios are this, like the price may be moving down, so that is in favor of what we thought. The target, that means we are profitable and we book and come out. But if the price moves opposite to what do we do? We convert that into a bullish strategy, what we learned last time, bull put, right? The bear put will convert to a bull put. How do you do that? we'll close the profitable short put, and then we will short a new put with a strike that is less greater than the other leg, which is the long put position, right? So please go and refer back to the bull put strategy. You'll understand. Basically, our view has gone wrong. So now, in order to reduce the reduce the loss, since we are assuming that our view has completely failed and the market is going the opposite side and it is shooting up. That means we just have to change our view also and convert, right? We just have to close one leg and book the profit and take another leg which is at a lower strike. It gets converted to a bullish strategy. So adjustment from one strategy to another strategy. This is very critical. If you want to reduce, if you have a large number of lots and if you want to reduce the loss, then you have to do this adjustment when it is required. So the second spread, we are moving on to that, which is bear call. What is the major difference between bear put and bear call? As the name suggests, we are using calls. We are taking a bearish view and we are using stop option strategies using call options only, not the put options. Both are call options. So what do we do here? Why do we do this? What do we do with the call options? We will sell it and buy it both. So because one side it will be profitable, the side will be loss. So it will balance off. So it will reduce the probability, reduce the failure chance, and also increase the probability of the winning. So right. So how do you construct that? We sell in the money call and we buy out of the money call. Right. So here you can see that this is the bear call spread. The payoff charts for that same like what we have seen for bear put. Here you can see 29th July 16,000. The higher strike option is sold at 120.95 rupees. Similarly, we are selling 29 July 15,700. See, it's a lower strike at 274. Right? You can see the probability of the profit, the maximum profit, maximum loss, maximum risk reward, break evens, and the margin requirement for that. Here also we can see that it is a bearish strategy. If the price is, this is the break even point, right, the center point is where, if it resides at 15,852 levels, then we are no loss, no profit. But as soon as it goes down, we make profit till maximum profit of 7,652. As the price moves up, since our bear strategy is bearish, if it is going up, it is bad, right? We'll start losing maximum up to 7,348. If you want to come out of that before that, we have to do the adjustment. Let us see how this is derived in the bear call. The maximum profit is equal to the net premium. What is the net premium here? Net premium is 274 minus 120, right? That is come to 150 rupees something multiplied by lot size. Now the net, it's the other way. So net premium was the maximum loss in the case of bear put. Here net premium is the maximum profit in the case of bear call. So maximum loss is calculated by the strike difference between the long and the short calls, and then you have to subtract the premium from that. That means 16,000 call minus 15,700 is 300 minus the difference in the premium, which is 150 multiplied by 50, which is coming to 7,348, right? And now how do you find the break even point? Break even point, the strike of the short call. Short call is 15,700 minus 15 plus, you have to add here, right? That's 700 plus the premium, that is 150, that is coming to 15,850, right? 15,700 plus 15,700 plus 150 is 15,850, something around that. So that is where the break even point, where there is no profit, no loss. It's similar to the bear put, right? Now here, where do we use the bear calls? Bear call is also like bear put, right? We use it when we are moderately bearish, right? But we are here, the difference is we are using call options, not put options. The price is expected to move down, right? We have seen in the charts that the price is at a major resistance level in the immediate upper side. That is the reason why we have taken this view. Now the higher implied volatility is there for the stock or the index, it is better, right? The stock itself has to be very volatile and liquid before we take up trades in positions. Sorry. So the implied volatility is greater than the historic. That is the time, since this is a credit strategy. So bear put is a debit strategy, while bear call is a credit strategy. So it is better to take when the IV is greater than the historical implied volatility, right? So now what happens if our adjustments, if our view goes wrong, right? We are bearish but it went bullish. What do? If it is moving down, then it's good for us, we'll book the profit. If it is moving up, right? A good way of adjusting, there may be different ways of doing it. A good one way would be to just profitable leg only keep it and non-profitable leg close it. But what if the market reverses again after some time, right? We'll end up with nothing or even more loss and no legs to protect. So adjustments, different ways are there. One good way of adjusting the bear call is to convert that into a high-end condor. So bear call will be having calls. So you will take a put spread on the other side, right? So you will buy a put spread by selling an OTM put at the same strike price of that of the other the call short strike, and then we'll buy a hedge position for that with the buying a lower strike put. So basically we will make it convert the bear call, which is the bearish strategy, into a neutral strategy of iron condor. We'll learn about iron condor in the future, but basically iron condor is nothing but retaining the bear call and then taking another spread on the put side, so that it market remains in a range. Probability of win will increase, the range may increase, right? There is a higher probability that we may come out with break even at least, right? So that is adjustment for the bear call spread. Now, as usual, there are certain general rules of taking option strategies. We'll just quickly go through that with the perspective of the bearish spreads. So first and foremost thing is the construction of the view with conviction is very important, right? So how do you come to, before we take a trade or before we see the payoff charts, we should look at the charts or look at the data of the open interest or price movement data has to be analyzed in order that we get a view. Where do you think the market is likely to go based on the price movement that has been happening historically, right? So that can be either upwards or downwards, right? So that view has to be there with proper study and proper convictions and confidence. That's very important for us to continue and do the trade properly, right? That will give good confidence for us to follow the rules basically, right? Now the days left to the expiry is also very important. How many days are left? So whenever we are taking a strategy, we have to take, if it is a weekly strategy, we have to take in the beginning of the week, not in the middle of the week or somewhere very close or on the expiry day. No, that is not the time to take the expiry. So the days left, the more days that we are left, the more flexibility we have to do the adjustments, right? The better premiums that we will get, right? Now adjustment is another mistake that so whenever there is some profit or some loss that reflects in the mark to market, we immediately go for adjustment and we'll end up in destroying the initial strategy that we had developed. Every time you adjust, you end up making the broker rich, right? You will do over trading. Over adjustments will take out all the profit that is there, and you will mess up with the initial strategy that we had taken based on the different risk parameters. So do adjustments only when you feel that it can save you from the losses. Like learn to cut the losses early and accept the small loss. Yeah, taking small loss is fine because you can always take another new position on the next expiry, and then that will give much more profit. But if capital is not protected, means you cannot even take another position for the next expiry. So another thing is the mastering. Every strategy has to be, it is very easy to theoretically see how it is, right? And understanding also is fine, but unless and until you practically go through the price movements, see the mark to market price changes, see the price that's moving across, going outside of your view getting broken multiple times, and your view is exactly how it is supposed to be, how you book your profit. So each of this requires you to take more, at least 100 trades has to be taken before you decide whether it's working or not, right? Another thing is, so don't wait for the last expiry date to book the profit. The profit has to be booked at a targeted rate, which is 30 to 50% ideal. So stop losses are not advised unless your position lot size is very huge, right? If your view is right, then stop loss, this bullish and bearish spreads would adjust themselves. The hedge positions will act as a stop loss. You know what is the loss that it can happen if it reverses. So it is already known. There is no need of additionally putting stop loss on each of the legs unless you are taking huge risky, huge position sizing and all that. Right? Otherwise, not required, right? So hedge position does not need a stop loss basically, right? So and also cutting down one of the legs and then carrying forward with the other leg should be done only if you're 100% sure that the market will not reverse. The market always surprises you, never can be 100%. So cutting down and running the other one over a week or a month is not a wise idea, right? So instead of that, do the adjustments of converting that into another strategy, which is, if you are very sure, rather than having only a single leg or naked options and let it run, which is not a good idea. Now, yeah, keeping the trade till the expiry day can give you surprises, because the gamma effect will come and then it will throw you out all the plans. Most of the plans may not work on the last expiry day, right? There will be a big fight between the bulls and the bear that happens, and then so book your profits ahead of that. The same thing that we told. Now, if last point that we are discussing is, if you have a confusion between the bear call and bear put, which one to take? We already discussed that. Depending on the IV, the implied volatility is greater, means go for credit strategy, which is bear call. Otherwise, go for the bear put, right? So always one criteria is the volatility. Second criteria is which is giving maximum loss. Don't go for that. Go for the other one, right? Right. So whenever we are going for high IV greater than the HIV, then that means it's a credit strategy, and you have the theta benefits also. So sideways movement also it will help. So these are a few criteria to think about which one to go. So beginning of the month, uh, the theta decay will be less. Theta decay will increase in the middle of the month. So credit strategies may work better, from the middle of the month onwards, right? So these are certain general rules that I would like to touch upon. So that way we have covered the bearish spread strategies also, right? So now we will be going through a demo of the construction of this in Abstra, and also we'll see how an order basket can be created for the execution of this. Yeah, let's go into Abstra and see. See, I have already created here. I'm just clearing off. We are going to, so 16,000. Let's say we are seeing a resistance there. We are going to construct something on the bearish, right? So you're going to buy this. You're going to see bearish put. Bear put spreads is what you're going to see. So we bought 16,000, right? Now we are buying 15,800, and we are selling this, right? So here it becomes a bear spread. You can see the break-even point 15,881, right? So anything beyond that it goes, it's not good. Anything if it goes backwards, it's profitable. So we see the profit. We see, right? We see the strikes. Both are put. The premiums. Net premium is 329 minus 210. Multiplied by 50 will give you maximum. So you see the profitability, 60% chance is there. Total capital that is going is only 15,000 for one lot if you're taking. So that gives a lot of premium advantage also, right? So this is a bear put. Now let us do the same thing by constructing. Let's close this. Same thing same spread will create with calls, right? So we are buying that, and we will go and construct the same width by selling a lower strike, right? So this is how we so this is another, it's made completely of two calls, not puts. So it's known as bearish call. So you 62% you see max loss, you see profit, you see premiums, strike prices of higher one sold. So it's all clear. It requires a more bad. This is a credit. So you are seeing a credit here. The other one we did not see the credit. This is a credit strategy. It's slightly costlier premium. The other one was 15,000 something. This is coming 24,000, right? So now, so we talked about converting that into an contour, right? So what do we do here? We can go and see the and contour for 500, right? And we can have a put and then sell it and do a put and buy it, then it becomes a iron quantum, right? This is how we are. This is not exactly the balance, it has to be same price, but this is how we construct a non-directional. We convert whenever we think that the bear call spread is going out of our hands, we convert that into a neutral strategy. We learn about this in the future sessions, right? So let's now get into the Shiroda and see how we'll create a basket for this bear call and bear put spreads. Yeah. So this is Shiroda's kite platform. This is where we put the basket orders. So we want to see whether how we'll create the execution plan or the order. How do you make it ready for execution for a bear call and a bear put. Let's see bear put first. So Nifty for July 16,000 call, right? 50 lots call we are buying, right? Then Nifty this is we are talking about first we'll see bear put Nifty July 16,000 put will buy, and Nifty July 15,800 put we will sell, right? So here we have a bear put spread with a margin that is required is 26,000 only. And this may vary slightly with the upstart values that you are seeing, but more or less this is the rate. Now let's see how we create a bear call. Right, we construct a bearish spread using the call options. Nifty June 16,000 call will buy Nifty June 15,800 call July 15,800 calls VSL. So this is a bear call. Right, so there's a mistake here. Nifty July 16,000 call we are buying. So it's coming to 21,000. Okay. So that's a bear call spread that is constructed. So just have to execute that. So margin requirements is what we see here. Yeah. So we have seen the demo for the construction of the spread using option and the how the order execution setup can be made. That's all we have. Kindly subscribe and share and hit the like button. It matters a lot for us, right? We promise you to come out with better better content, strategies and options for the beginner series in the coming days. Happy trading and happy learning. Bye.